kind of describes a growth value investor. We're going to walk through some of his methods and some of the tools we have here at Guru Focus that can help you mimic what he did and help you try to find some 10-bagger stocks. So a quick disclaimer, obviously all the information we present here is to the best of our knowledge, true and accurate. However, if there are discrepancies or errors, please forgive the fact that we are humans there. Now, Peter Lynch, for those of you who don't know, as I mentioned, he headed the Fidelity Magellan Fund for 13 years. This was kind of, he came up as an analyst, became the head of research, then was handed the helm. The Magellan Fund was a small fund at the time, I don't know what it was, $20-30 million, something in that range. By the time he left it at billions of dollars, and the reason is that annualized return of 29.3%. Phenomenal track record, unheard of in the mutual fund business. He was famous for what he called 10 baggers. Now, a 10 bagger is a stock that increases tenfold. So you bought it $10 and sold it at 100, or bought it at 1 and sold it at 10. It's a 1,000% return. So if he mentions a 4-bagger or a 5-bagger, that's a 400% or 500% return. It's something we're not used to as individual investors, but Lynch actually bought more than 100 of these stocks that gained 1,000% or more while he was at Magellan. Now, he's best described as kind of a growth value investor. And the reason is he's not a true value guy like Buffett and some of the others, just look for discounted assets and kind of cigar butt type investing. He was definitely more of a growth investor, but what separated him from the other growth guys is his value-based discipline. And here's a guy who wanted to own what today would be, Amazon and 3D Systems and Netflix, but he had a really firm set of guidelines that forced him to buy growth only at value metrics. Okay, so it may not be 10 times earnings, but it's value relative to how fast the company's growing. Now, he wrote 2 books, one up on Wall Street and Beating the Street, and is famous for his philosophy of invest in what you know. And he wrote these books, really this is what a lot of fund managers don't do if they retire. It's shared everything he knew with retail investors. So we're all kind of indebted to him for that. And his invest in what you know philosophy really just says, you know what, you're not going to be a master of all areas of the market. You may not understand, advanced semiconductors or the solar industry, but most people specialize in some area depending on what you work in or what you're familiar with. And he thinks people should focus on that area of the market they are the most intimately familiar. Now, in his books, he identified 6 categories of stocks, and as a lot of you probably know, some of you don't. Most investors when they're buying a security have different goals and objectives depending on what type of investment that is. So in other words, not all stocks are created equal. So I'm going to walk you through those 6 categories that he identified, and we'll show you how he played each of those, and we'll focus on the 2 main ones. Slow growers, stalwarts, this is a word for medium growers, fast growers, cyclical stocks, turnarounds, and asset plays. These are his 6 main categories. Now I'll explain what each of them is. Slow growers, as the name implies, are very slow growing companies that are large, aging firms. They're expected to grow maybe slightly faster than the gross domestic product. You guys know it's, what is it, 3% a year, 4%, something very, very minimal. These companies tend to pay generous regular dividends because they can't think of new ways to expand the business. They've got all these earnings coming in. There's really nothing they can do with it. So as they should, they kick most of it back to shareholders. Example, this is utility stocks, right? I mean, utilities, there's not a lot of space for them to grow. I mean, where I'm from, there's kind of monopolies in certain power grids and water companies. You don't have a whole lot of choice there. So there's not an extra, special marketing they can do to grow the number of electricity subscribers or people on the water grid, right? They're just going to grow with the gross domestic product. Stalwarts are more medium growth caliber stocks. All right, so these tend to have 10 to 12% annual earnings growth on average, and Lynch saw about a 30 to 50% gain from these stocks. So here's immediately saying, these are not stocks I'm trying to make 4, 5, 6, 700% on. And these are your large, familiar companies. They're good protection during recessions and downturns. Examples: Coca-Cola, Bristol-Myers, Procter & Gamble, 3M. These are companies that we're familiar with. It's the Dow 30, right? The stocks that we're all very common with. Your dad bought, your grandfather might have owned, right? These are stocks you're not going to make triple, quadruple your money in a couple of years. So he's simply looking to buy these when they're undervalued and sell them when they reach full value. Third group is fast Take Crocs, for instance, back in the early 2000s. The shoe industry is not really a fast growth industry, but here's a company that was growing and growing and growing market share. So with these, he really focused on looking for a clean balance sheet and profitability. And a lot of IPOs that have come out recently, they're out there on the market, they're trading, they offer shares to the public, and the company's not even profitable yet. And there's a lot of these out there. And what Lynch found was that the most successful businesses, ones that be replicated, which is the process for clean growth, are profitable from the beginning. Maybe not the first month of operations, but by the time the company goes public, you should be profitable. And you want to look at a good growth stock, take a look at the history of Chipotle Mexican Grill, ticker symbol CMG. It's a company that was profitable when they had one store, they were profitable when they had 10 stores, they're uber profitable now they've got 100 or 1,000 stores. So if a company has a hard time making money until they get to a certain size, there's a lot of risk that company could go bankrupt and you'll lose a good deal of money. The biggest thing here, be careful not to buy at the end of the growth phase. We'll talk about when that happens, but essentially what happens with stocks, a company that's growing at 20, 25, 30% a year is going to trade at a higher multiple than, say, Walmart, right? If it's a 30% grower, you may be willing to pay 30, 40 times earnings for that stock. If we're talking about a Walmart or, a more stable company, you're not going to pay such a high multiple. You're not expecting the same amount of growth. And what happens is when these fast growers become stalwarts or become slow growers, which they all eventually do, that earnings multiples reduce. So even if they continue to grow, they're not doing so at the same pace. The stock price will be revalued and take a big hit. So examples, these are fast growers now: Netflix, Tesla, Stratasys, CMG, another good example I gave you. BioReference is one we're watching. Now, cyclical stocks, the fifth category here, they're just stocks that are in an industry that expand and contract in these cycles, right? They tend to rise really fast coming out of recession and fall really hard in downturns. So like late 2009, 2010, these stocks outpace the market. As soon as we pull back, they're going to take some of the biggest hits. Many mistake these as stalwarts, those medium growth companies, and fund managers do this as well. It's one of the biggest mistakes people make with these types of stocks. And the way to invest in them, timing is really everything. Okay, so here are examples of cyclical industries: the auto industry, airlines, tires, so it's like Goodyear and the like, steel, and chemicals. And if you look at these charts, just when you have some free time, look at a 10-year chart of Ford or Goodyear Tire or Dow Chemical or U.S. Steel, you'll see them look a lot like this. And they may be growing, but they're very cyclical. It's like a big mountain range. As the business cycles take place, the stocks swing pretty wildly versus a non-cyclical stock that may experience some of that, but is more of a steady growth. Okay? Fifth, turnarounds. Now, these are companies that have been battered, depressed, near bankruptcy. And they're not slow growers, not medium growers. They're really just no growers. They're not going anywhere. These are kind of big risk, big reward situations. And Crocs, which I mentioned before, is one of those successful turnaround a few years ago. Stock traded down around $1 before going all the way back up to 30. These are very difficult to invest in because it's nothing you can, if you just kind of know the basics of finance, reading financials and stocks, it's not something I would encourage people to get into day one. You just have to really dig deep. I mean, the rewards are great if you can get it, but it's not easy to find. You've really got to dig down, read through the annual reports, understand how much debt they've got, what the structure of that debt is, what the CEO and the company's plans are for turning around. You've got to have a little bit of sort of kind of magic ball, crystal ball syndrome. You can kind of forecast whether you think that's going to work. The biggest focus thesis is debt, right? I mean, if a company has no debt, they cannot go bankrupt. And most turnarounds are facing the brink of bankruptcy, and the debt is what always puts them over the edge. So, if it's a company that spends $100 million a year paying the interest on their debt, they got to make a pretty good amount of money just to stay afloat. Or if they have no debt, they can just cut costs, and shrink down to the appropriate size. So examples of going on right now: Radio Shack's one just been hammered. We know the story of Radio Shack. You probably haven't been in one of these stores in 10 years. Crocs is successful, I mentioned. BlackBerry's another that could be a potential turnaround here around the $7 range. The stock that once traded $140, $160 a share. They lost huge market share. Now they've got John Chen, a new CEO, stepping in. He's got new plans. He's moving them away from the retail smartphone market. They got a contract to just manufacture phones trading at $10 a share, and you go through their balance sheet and say, if we shut down the business tomorrow, sold everything off, took the cash, sold the building, paid off our debt, there'd be more than $10 a share there. Okay, so that's a net now. There's more in assets. It's worth more just shutting down tomorrow. Assets come in a number of forms. It's easiest for us, but just in a balance sheet in cash. It's easy to see. There's going to be real estate that is being held at a value much lower than it really is worth. Mineral rights, patents, TV stations, tax bills carried forward. The list kind of goes on and on. Examples of BlackBerry in 2012 was one that before they had the big write-downs, they had a balance sheet worth $10-11 a share. It was trading at $7. MSN, Emerson Radio, is one I was watching last year. It was trading about $1.50, $1.60, and they clearly had $2.30, $2.40 on the balance sheet with no debt. So these are some of the easier play. You just got to put your money in, put a limit order to sell when the value's reached, or when it gets 90% there. You don't have to really do much with it. On the other hand, if they're losing money, they're going to eat up those assets. So if you want the cash in that stock and they're losing money each year, they're going to be burning less each year going forward. So that's the 6 categories of stocks. I know we kind of went through those fast. This is being recorded if you want to watch it back later. We tend to focus on 2 of those categories. This is really where Lynch did the majority of his investing, at least in terms of the amount of capital allocated. Those 2 categories are stalwarts, which is the medium growth, our Coca-Cola, our Procter & Gamble, the big companies, and the fast growers, the small cap stocks that are showing 25, 30, 35% annual growth that we can get at a fair price. So let's look at how to get into these. Stalwarts, again, as I mentioned, 10 to 12% annual earnings growth. Generally, these are mid to large cap, very familiar stocks. And one of the best tools on the site for identifying buying opportunities with these is something known as the Peter Lynch chart. Now, how many of you guys have ever fooled with the Peter? How many of you have never seen the Peter Lynch chart or never touched it? Just type no if you've never seen that. Okay, so there are a handful of you never seen it. So it's a really cool chart. It was actually created by Peter Lynch, and we are one of, I think, 2 companies that offers it now. Ours is actually interactive. It's really, really cool. This is what it looks like, and it's actually fairly simple what it does. So there's 2 lines being plotted. These are not technical indicators. This is fully fundamental. It's just a different way to display the data. So the green line is the stock price, right? It's a regular chart like you've seen any other time. Stock goes up and down. We all know that. Now, the other line is this blue line. It's something called the earnings line. And what it is a hypothetical price for the stock at 15 times earnings. Okay, so it says this company earned $2 a share last year, therefore 15 times 2 is 30. That's a fair price for the stock. And the reason I use 15 is just kind of a commonly referenced figure for the value of a business. You'll hear it a lot. 15 times earnings is really that baseline figure for what most stocks should be worth. If it's a consistent company that's always profitable, with moderate growth, should be worth 15 times earnings. You get a good stock at less than 15, it's a good buy. You get a good stock over that, maybe you're paying a little too much. So, we know that historically stock prices follow earnings, right? This is not a secret to any of you. I mean, we hear on CNBC, such and such beat earnings, the stock's up 10% after hours. They missed by a penny, the stock's down $10. It's got fluctuations in the meantime, as we see. But for the most part, if earnings are growing, the stock is going up. If earnings are declining, the stock price is going down. Price always follows earnings over time. So what we get is the market is fairly efficient over the big picture, but in shorter terms, over the shorter term, there are inefficiencies, and that's what we're trying to capture. So this is a chart of Apple. Now, Apple's kind of a tough one because it's one of the best stocks in history, but you see that the best time to buy this, anytime it trades below its earnings line, Lynch would look to buy these stalwart stocks. And Mark, it's reported earnings per share, so net income. Yes, it's what the price would be if it had a PE ratio of 15, okay? And I'll show you some more of these stocks, but essentially all he tried to do, and this is only with the big familiar names, if they're trading at a big discount of that earnings line, he'd build a position. If they're trading well above it, he either wouldn't buy, or if he already held it, he might take this as an opportunity to sell
when it gets really overvalued or really extended from its earnings. So there's kind of, not a great place to buy, really good place to buy. Now, buying back here in 08, you still would have made pretty good money holding it to now. But, you just seen your stock price cut in half, and it would have taken you, 2.5 years to get back to even. So most of us would have probably sweated that out. And Herman's asking, how do you determine the P should be 15 for Apple? Herman, the chart uses 15 for any stock, just because it's kind of a fair value of any moderately growing stock. It's 15 times earnings. So anytime you hear, where's the earnings line, that's the 15 PE price level, okay? So here's a couple of others. This is General Electric. Again, over the last 10 years, we see when it got well in excess of its earnings line, big discrepancy there between what they're earning and what the stock is paying for. Not a great time to buy. We saw it in 05. We saw it in 08. And then when we had an opportunity anywhere there below the earnings line is a pretty good spot to pick it up. Now, obviously we had the crisis that really killed their earnings. But the best time to buy the stock are here in these spots where it trades at a discount to that. And it's probably one of the safest times to buy these familiar companies. So here's Microsoft, same thing, relatively flat stock price, right? But the earnings have been increasing. Yet the stock price has been relatively flat. Why is that? Because the stock price went too high above its earnings, and it just traded at a price that could not be justified by this earnings figure. So price of the stock sat pretty much still for years until earnings caught up to it. And once again, here's some of the better points to buy this stock. Any of these times below, and this is one that happened just last year. They missed earnings. It fell into $30. The earnings line was at around 40. You're getting a really high caliber stock at a 25% discount. It's almost easy money. Another look at Walgreens. Walgreens, one of the best, most consistent companies in the market. Earnings really stable, but we see the same thing happened. It got very much overvalued here in 2005, 2006. The company kept growing its earnings, as we can see. It kept going higher and higher, but the stock price did nothing. And those people that bought it back here had to sit on their hands for 7 years before they broke even, just because they paid too high of a price. But those people who waited for a chance to get it below at any of these points in here did extremely well with this stock and didn't see much price action against them. Now, I've got a question. Edwin says, is it a problem that earnings reports lag 1 quarter or more when using the Peter Lynch chart? Edwin, good question. Not really. I mean, if you see stocks whose earnings line, look kind of like this, it's going to be a tougher stock to invest in, right? It's not really predictable. But, the ones like Walgreens here, I mean, there are some little hiccups, but for the most part, it's a pretty smooth growth here. And Lynch charted his only with the annual numbers. He didn't even use it on quarterly. He had them printed out and sent to him. So it's not something we got to get in this week. You're going to miss the opportunity. Generally, this is just time to identify, those top quality stocks when the price gets down there at a discount. And Eric's got a question. He said, you can only do this on big known companies. Can you do it on smaller companies as well? You can, and I'll show you some of that in a minute, Eric, and I'll show you kind of what we're looking for there. Here's John Deere, same thing, great opportunity here in 09. And Deere's really one that could be a good buy now, right? I mean, this is a stock that's historically traded pretty closely to its earnings line, and all of a sudden earnings have continued higher, and the stock really hasn't grown as much. It has lagged its earnings. So if I'm looking at Deere, I know it's a strong company. If I don't see any real market risk with them, I'm seeing about a 50% upside just on revaluation alone with Deere. Now, this chart's about a week old, so the price has changed, forgive me, but here's one. And again, we look at a lot of these charts, and that's what this right here is what this Walgreens chart looked like back here. So we can't see the forward side of this chart, but if I had to try to predict the future, I would speculate that you're going to see 2 years from now, John Deere doing one of these. And I wouldn't be surprised if we see it $150, $160 a share. Mr. Market, exactly, Greg. Yeah, Mr. Market's giving us a good price. Scott asks, are you aware of Lynch ever shorted companies that appear overvalued based on this chart? I'm not aware that he shorted them just based on this chart, and I'll show you why in just a second. I don't think he did much shorting at all. If he did, it was probably in pairs where, he'd short something really overvalued and buy something really undervalued in the same sector to try to hope they'd come together. But for the most part, he didn't really short. He's just a long equities guy, really bullish fella. Here's Herbalife once again. It's one under a lot of controversy right now, but you can see pretty quickly. Here's Ackman short in December of 12, and here's where Icon started buying it. I mean, he just saw. He did more homework than this, but he saw what a big discount it's trading to at its earnings, and you saw where did it go. I mean, it hovered pretty much right there to 15 times earnings, and now we have a chance to buy it at a discount once again because the investigation's going on. And finally, this is AutoZone, AZO, and this is what we all dream of happening when we buy a stock. This is a company, it's not sexy, it's not, biotech, it's not 3D printing, it's auto parts. On the corner, it's greasy guys, guys with greasy hands behind the corner. I go there all the time, not knocking the company, but it's a very boring business. But here's what happened. So you bought this anywhere below the earnings line, you had years to do it, and what happened, earnings kept rising. And the stock stayed pretty close to its earnings line. It never went so far to say, I got to get out of this. And as long as earnings are growing and the price is near its earnings line, there's really no need to do anything with the position. Now, at this point, it's getting a little bit hot, right? It's probably the furthest it's been from its earnings line yet. But, this is the ideal situation. It's one that, again, it's been glued to its earnings line, but earnings have grown. And you get the revaluation from the discount to the line. You also get the growth there. 10 bagger, as Jeff put it, absolutely. This has been a monster stock. Andy, with so many accounting gains played with earnings, how can you use the Peter Lynch chart, free cash flow per share, even residual earnings per share? Andy, I'll show you that. The one on the site, you can do with free cash flow as well if you'd rather. This is what Lynch did, so it's what I wanted to kind of share his techniques just because of his legendary status and success he had. Akil's asking if we should keep the PE constant at 15. For these stable companies, yes. In today's market, you're going to find there's not a lot of stocks under it. So you can actually adjust our chart to make it 18 or 19 or 20 times earnings to find it then. We'll cover that when we do it live. Now, as I mentioned, this is for stalwarts, right? This is for medium, big. You're familiar with the name, right? I mean, I shouldn't really need. It's just Coke, PG, 3M, Kraft Foods. You know the stocks. So what if we tried this on like an Amazon? And I'll show you why it's only for these stalwart stocks. This is what it looks like on Amazon. Okay, this if you look at this thing back in 2005, 2006, say, oh man, it's trading at like $70. Its earnings line's at 10. No way. This is why you don't short these things, because there's no level to the stupidity of the market. This stock has climbed hundreds of percent. In earnings, meanwhile, have not. I mean, this company makes $8 a share, and they're trading it in 330. Things are down to maybe 300 now. They were at 400 at the beginning of the year. So why is this? Well, it's not a stalwart stock. It's a growth company, number one. Two, this is one of those weird stocks that Wall Street just gave a free pass to. I don't know why, but Wall Street just doesn't care about their earnings. They've got a lot of belief in the infrastructure they're building and things can be valued. This is why, one, I don't short, and two, you only use it on stalwarts. Now, what do you think Amazon's price follows? Okay, this is one that has been just skyrocket. It's obviously not following earnings. Who can tell me what moves Amazon's price? What fundamental metric? Boom, Kai, you were quick. Kai Chin gets it. The answer is revenue. That's correct. Look at this chart right here. How closely does that follow? You know what this is? That line is a price to sales equal to 2. So it's a hypothetical price equal to twice sales. So, if they had revenue of, say, last year they had revenue of around $160 a share, double that, there's $320. And that's what moves Amazon. Unlike most stocks in the market, it's one of the few that does it, but it's just moved by sales, even though there's not really any profits here. And you see it got a little bit overvalued, and here's that correction that's pulled down right to around 320, 300 now. And this is the same chart. I'll show you how to use it all. So yeah, stock price at price of sales, price over sales equal to 2. Okay? So that's stalwarts. And before I get into the fast growers, let's go ahead and look at this chart we're mentioning. I can show you how to use it. It's really, really cool. One of my favorite features on the website. It's called the interactive chart. And we'll just put in Apple. It's always a crowd favorite. And we scroll down here to interactive chart. Now, if you happen to be on the financials page or the summary page, just click the interactive chart tab right here across the top. It'll work with any stock. And from here, you can plot pretty much anything. Now, this goes back pretty far. We've got this all the way back to 1990, so look at almost 25 years of data. I'll scoop it down to the last 10. And you see all the things you can plot here. I mean, as humans, a lot of us are kind of visual creatures. We'd rather see it than look at a big sheet of numbers. And this chart does more than any other tool to help you use that. Now, we've also got some predefined charts in here, one of which is the Peter Lynch chart. So we just hit the drop down, select Peter Lynch chart, and immediately plots it for us. So we've got in blue, let me see if I can blow this up for you guys. There we go. That's better. So in blue, we've got the price of the stock, and in green, we've got that earnings line. And just as we saw before, big discount here. We're still trading at a bit of a discount now, but you see the stock rallying, earnings beats. The thing just kicked up a couple of days ago when they beat earnings expectations, and now it's 627, so it's still a little bit undervalued by this. And you can quickly switch to another stock with a switch ticker symbol here. You can go all the way through the same process. If we want to look at IBM, hit in there and click go. Select the Peter Lynch chart. And there we have it. So this is another one trying to get a bit of a discount. This one's a lot of value guys watching this stock. This is one of the reasons why. Now there's tons of things you can plot here, and I want to show you some of this. Now someone asked me about free cash flow. I don't know if we have price at free cash flow. We'll have to add that. But what you can do, you can search through series here. So if you want like free cash flow, you can plot that and see the free cash flow per share on here. Let me take some of these off. Now you can see the PE ratio. Someone asked about plotting the historical PE ratio of different stocks. You can do that as well. So one of the ones we were looking at earlier was John Deere. Whoops. If we bring up a chart of John Deere, here we can see where that PE ratio historically has been. Now, this one's a bit all over the map because of the way their earnings end up structuring, but we see some blips where it got to 80 and et cetera, et cetera. But we can also get it for most stocks. We get a pretty good idea of what that is. And let's look at one that's a little bit more stable. Let's look at Walgreens, see if we can get a better picture. And here's an idea of Walgreens. So
today's lunch. James Johnson, Chairman and CEO of Fannie Mae. Representative Edward Markey, Democrat from Massachusetts and Chairman of the House Subcommittee on Telecommunications and Finance. Lee Shepard of Tax Notes. David Weiss of the Washington Post. I'd also like to thank the staff members who organized today's lunch. Melissa Bender, Sherry Burton, Melanie Abdo-Dermot, and Jeff Tarbell. There's one thing you have to understand about our luncheon speaker today. Sometimes Peter Lynch may look as if he's going out for a sandwich at lunch. But what he's really doing is trying to figure out if Pen is a good investment. Lynch is always on the prowl for a good stock. One friend says that if you came to him with the best widget in the world, and the Queen of England were sitting on one side of him and Cindy Crawford on the other, he would ignore them and inundate you with questions about the widget maker's management. His intense interest in anything that would produce a good return is one reason few people have had a greater impact on the investment world. In fact, the market dropped about 40 points one day when a compressed version of his market views went over an online computer service. He had said that if you looked at markets over a 20-year period, there were ups and downs. But that got translated into the headline, Lynch predicts market correction. But the Lynch legend is based more on what he has done than on what he has said. He helped transform investing by giving individuals access to a mutual fund that steadily outperformed the market and competitors for more than a decade. His performance at Magellan earned the appreciation, pun intended, of many Americans who paid for their kids' college through Magellan's growth. When Mr. Lynch became portfolio manager for Magellan in 1977, it had less than $20 million in assets. By the time he retired in 1990 to spend more time with his family, Magellan was the largest mutual fund in the world, with more than 1 million shareholders and approximately $14 billion in assets. It's easy to see what attracted shareholders to Magellan. The share price had risen 28-fold since Mr. Lynch had taken the helm, with annual increases averaging 29%. Even more remarkable, though big funds are supposed to have more difficulty than smaller funds in outperforming the market, in the last 5 years of Mr. Lynch's stewardship, Magellan outperformed 99% of all stock funds. Given his golden touch, excuse me, it's no surprise that Mr. Lynch's books, One Up on Wall Street and Beating the Street, I have one here, have been bestsellers. His message is really rather simple, if he'd allow me to paraphrase it. He thinks anyone can get rich in the stock market if they do two things: use their powers of observation and do their homework. Still, Mr. Lynch knows how to lose money, too. The Magellan Fund lost about $2 billion, maybe more, in a single day in 1987 when the stock market crashed. I personally hosted Mr. Lynch once before, a few years ago, and he was discussing his views on the stock market, and I asked him to give me some examples of stocks he liked at the time. He suggested Sbarro, the Italian fast food chain, whose price rose remarkably over the past few years. And he also recommended Texas Air, which dropped, crashed to nothing. So I think he would agree that he is not infallible too. A native of Boston, Mr. Lynch is a 1965 graduate of Boston College and received his MBA from the University of Pennsylvania's Wharton School of Business Administration. He served as a lieutenant in the Army before coming to Fidelity in 1969. He currently serves as vice chairman of Fidelity, sits on the boards of Morrison Knudsen and W.R. Grace, and is heavily involved in charity work. Will you please welcome Mr. Peter Lynch.
Thank you very much. It's a pleasure to be here. I love this town, and it's a thrill to be here with Jim Johnson, who did so much for Fannie Mae, and that was the greatest single stock in my life, and it's still my largest position. And anybody wants to talk after about how to make money, I'll tell them how to buy more Fannie Mae, and I've added Freddie Mac to the list too. And Congressman Ed Markey, who went to Boston College and also Boston College Law School and has done a great job in Congress for everybody in this country, but especially the people in his districts in Massachusetts. But great honors to have my wife Carolyn right here, my sweetheart, my great stock picker who found legs and a bunch of other good stocks. So what I'm going to try and do today briefly is, I don't know what I'm supposed to do with this gavel. I've never had one of these things before. I'm going to try and say some words on the things I've used over the years when I was an amateur, when I ran Magellan, I still use today. I think they make sense. I think they make a lot of sense for investors, and I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance, that the big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on unusual lows, they push them on unusual highs. For someone, they can sit back and have their own opinion, know something about industry. This is a positive. It's not a negative. So that's what I want to talk about. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 Whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happening. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get a mobile travel guide, or California. When they go to Europe, they get the Michelin travel guide. People will hear a tip on the bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we're being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try and predict interest rates. I mean, this is it. If anyone would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. A lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we had the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, our interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I'd be fair. I'm talking about economics on the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancies. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about that. When I own Fannie Mae, or I own a housing stock. These are facts. There are economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan is a very honest guy. He would tell you that he can't predict interest rates. He can tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states, you keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could wait 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase the security. They're out of breath when they call up. You don't need to do this. It's you need an edge to make money too. People have incredible edges and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. Now you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product that you took it for $1 and it went away, but it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and tripled your money. So you only need a few stocks in your lifetime. They're in your industry. I think of people, if you've worked in the auto industry, let's say you're an auto dealer the last 10 years. You would have seen Chrysler come up with a minivan. You've seen, if you're a Buick dealer, a Toyota dealer, Honda dealer, you would have seen the Chrysler dealership packed with people. You could have made 10 times your money on Chrysler a year after the minivan came out. Ford introduced the Taurus Sable, the most successful line of cars in the last 20 years. Ford went up 7-fold on the Taurus Sable. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of 5-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching it. And they have incredible edges. People have big edges over me. They work in the aluminum industry. I see aluminum industries coming down, inventories coming down 6 straight months. They see demand improving. In America today, it's hard to get an EPA permit for a bowling alley, never mind an aluminum smelter. So when aluminum gets tight, you just can't build 7 aluminum smelters. So when you see this coming, you can say, wait a second, I can make some money. When an industry goes from terrible to mediocre, the stock goes north. When it goes from mediocre to good, the stock goes north. And it goes from good to terrific, the stock goes north. There's lots of ways to make money in your own industry. You can be a supplier in the industry, you can be a customer. This thing happens in the paper industry, it happens in the steel industry. It doesn't happen every week. But if you're in some field, you'll see a turn, you'll see something in the publishing industry. These things come along, and it's just mind-boggling, people throw it away. One of the things I find, a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis, the stock has gone down this much, how much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's not 95, what a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company that was just so overpriced, it went down. I did the same thing in my first or second year of Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And Now, fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. I was able to, this compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement, but they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? It's psychiatrists that haven't worked so far. I've never seen them running in. The psychological psychiatry fund, I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer, that hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying the stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. If people say it's 3, how much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling short at 7, they're selling short at 6, at 5, at 4, at 3, at 2, at 1.25. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? Now, here's a subject that you probably all talked about. Getting close. All right, we'll drop that one out. It's getting very close, so everybody has to go somewhere. So the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. No, you have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day. So you have to understand that and stay with it. And then I'll switch through to my long shots. Avoid long shots. I bought about 30 long shots in my life. I've never broken even on one. The ones that are really bad were called whisper stocks. And if Arthur Levitt was here, he'd appreciate these stories. But these are the kinds that somebody calls you up and say, hi, Peter, how's Carolyn, how are the kids? I'd like to talk to you about International Blivet. And what they have in this company is very good. We call that earnings. Earnings going to be very, they're going to be big, small. It's $3, $1 share. And they keep whispering, and they say, what are you talking about? I don't understand it. And these are Now, either they're so surrounded by people that are going to run out and buy this stock because it's so exciting, or they think the SEC is listening in, they'll get a shorter term. They'll get 6 months in the camp rather than 2 years in the camp. But whisper stocks don't work. And then I want to conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession. In the early 50s, they said we're going to go right back into a depression. People worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You get under your desk. I never thought even then that was a particularly good thing to do. If blow was some people in a hat would all get under our desk, But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, the century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And then we're going to have a depression? And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. It's a company with a 20% savings rate, incredible workforce, incredible productivity, and people were saying we're going to have a depression because Japan's going to collapse. And they had, on their prayer list, they loaded Mother Teresa and crippled children, and they were praying for Japan at night. It's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? All these countries, Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and Soviet, and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends and we're going to have a depression. Or the Great Depression. We're going to have the Great Depression. I never could understand that adjective in front of depression, but the Great Depression is, the big one. The big one's coming. But all these countries, and now I understand, these are called then they were called less developed countries. Now, we used to call them underdeveloped countries. Those are all wrong terms. Those are not politically correct. You have to call these emerging countries. You can't use less developed or underdeveloped because that's, in fact, the other day I heard the politically correct term for someone that's overweight is laterally challenged. That's so there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8, get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
Okay, thank you very much. When managing a portfolio, do you pay much attention to the activities of Congress and the regulators?
Did Ed Markey put this one up? I'm not sure. I spend 0 time thinking about what's happening down here in Washington, and I spend little time thinking what's going on in Russia or China. I just deal with facts. When the economy's going down, when the economy's going the wrong way, I can deal with that. This whole health care reform bill drove a lot of drug stocks down to low levels, and I could say to myself, well, 60% of Johnson & Johnson's earnings are outside the United States. Their pharmaceutical drug business is all on patent. Nothing's coming off patent. They only have 5% of sales from one product, which is Tylenol, which is already an over-the-counter drug and it's growing overseas. I says, why is this stock come from 58 to 36? And these companies are already dealing in Japan and overseas with they already have the government controlling pharmaceutical prices. They've dealt with it. So I deal with facts. They might, this year, I thought it was very likely they'd have a bill passed on health care. It didn't happen. They drove the stocks down, but I think the stocks would have rebounded anyway, even if the healthcare bill was passed. So I don't deal with what's happening in Congress or what's going to happen in the future. I just deal with what's happening in the economy and what's happening in companies I call.
Thank you. How useful is the financial reporting in the general daily press to you, and how useful should it be to investors in general?
Okay. It has improved dramatically, not just in the press, but also company reporting. 10 years ago, companies didn't have interim balance sheets. So I'd imagine they only gave their balance sheet to you once a year. Now they show you quarterly what's happening in their inventories, what's happening in receivables. And now in the major newspapers, they'll even show types of funds. There are now, I think there's 2,500 companies in the New York Stock Exchange. There's over 5,000 different mutual funds. So there's twice as many mutual funds as there are stocks. At least in the paper day, it explains what kind of fund this fund is. So I think reporting has improved. They report earnings. But again, I think if you own auto stocks, you shouldn't be reading the financial part of the newspaper. On Wednesday, the local newspaper, Tuesday, some places are on Saturday, they have a whole 4 pages on automobiles. They talk about new models, and they say this one stinks and this one's outstanding. They really, if you own auto stocks, that's the part of the newspaper you should be in. You shouldn't be calling your broker 4 times a day to get stock quotes. It doesn't work. Getting up in the morning to look to see how your stock did yesterday is not useful. All this stuff is just a waste of time. If you're adding up how much your stocks are worth, absolute waste of time. You should be looking at the company when you get the quarterly reports. You should be, if you're at the mall, imagine if you were in the retailing industry, or if you're in the restaurant industry, you would have seen Taco Bell, you would have seen McDonald's, you would have seen Toys R Us. I mean, you would have seen all these companies do terrifically well. You would have seen Bombay, you would have seen Tandy with Radio Shack, and you would have seen Radio Shack roll across the country. Pretty soon there were 25 Radio Shacks in every major city, and you said, there's not much room for them to go. But they had a 20-year great run. That's what you're dealing with. You're not dealing with the minutia of today. You're dealing with what's this company doing 2 years, 3 years, 4 years, 5 years from now. And if you're dealing with a cyclical and business is turning around, you wait for signs that business is slowing down. When you see it, you move on to something else.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they could buy it out. I think volatility is terrific. I think I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
We're in the month of October. Beware of the month of October, the witching month for the stock market. What do you see as the outlook for this month? And when do you think the Dow will hit 4,000?
October has always been a special month. I remember in 1987, I was very, I was very convinced the market was not in trouble, and I didn't worry about things. And Carol and I planned this great golf vacation to Ireland, and we're going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland. play golf, and we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we completed our day, and I got back to the hotel and I called, and the market had gone down 112 on Friday. And I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from I think 12 billion to 8 billion, and that gets your attention, in two working days. I said at the end of this week I'd be have no fun. Now there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open. By 12 o'clock it was in Ireland. It was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, "Well, what's Lynch doing?" They said, "Well, he's on the 6th hole, and he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning." And I don't think that's exactly what they want to hear. But so I could do something about this damn thing. So I came back home and suffered with everybody else, and fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, the company's doing well, they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just roll those out, and I'll now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's it. That's all I ever know about the stock market.
Well, we have, as you can imagine, many questions.
I thank you for watching. Dave Natch. I'm out.